Good evening, everyone. So today we start with joint arrangements in days 111. That is what we'll be considering, and after that we'll also talk about days 28. We'll also talk about days 27 briefly, and we'll try to understand how are various aspects accounted for as per in days 111 and in days 28. That will be core of our discussion today. Right now, when we talk about joint arrangements, what are joint arrangements? When we say joint arrangements, there are two parties coming together. Now when two parties come together, and when both the parties they are doing something together, we will cover them under Ind AS 111 subject to certain conditions. Okay, so this talks about joint. Now, just give me a couple of minutes. This need to connect this. Just give me a moment. So we're starting with Ind AS 111, and Ind AS 111 deals with joint arrangements. Now, what are joint arrangements? Basically, there are two or more entities. We'll talk about two entities. There are two entities, let us say Reliance and Tata. Okay, Reliance and Tata. Now, what these two entities do is they come together and they start a business. Now, different scenarios are possible. One is Reliance and Tata, they invest or they create a new company where each one of them have, let us say, 50% control. They create a company and they run a business, or they simply enter into a contract. And based on that contract, or they simply enter into a contract, and based on that contract they run this business together. Right now, whenever these two parties come together and they have an arrangement, or when they have a contract with basis which they together control this arrangement, so this business is an arrangement, and this business has a both these parties have joint control. Now when we say joint control, what we mean is Reliance and Tata, both of them will decide for this particular business. One of them cannot decide without the consent of the other. See, if only Reliance decides and controls the business, then Reliance will control the business and the business will become a subsidiary. But here we are saying Reliance as well as Tata, both of them have to decide. Means if Tata says no, the decision cannot go further. For example, you want to acquire another business. both Reliance and Tata have to give their consent. Only then we say that there is a joint control. Okay, so both the parties have to have, or both the parties should decide that okay, a particular decision has to be taken, and that is when we say that it is a joint control. Right now, sometimes what happens is, even if, let us say, A has 50%, B has 50% stake, and the arrangement says to pass any resolution we need 60%. Now, can A alone control? No, A cannot control. Can B alone control? No, B alone cannot control. Both of these have to come together, and only then they can control the arrangement. Or let us say A has 55%, B has 45%. Now, normally with 45% we get control, but if the arrangement is such that the resolution requires 60%, then can I say A controls the business? A doesn't control, because I need 60%, means I need consent of both A and B. So that is where we have joint control. So you have to look at actual scenario, or the implied scenario, where whether both the parties have joint control or not. Sometimes just by looking at 50% or greater than 50%, we should not get into a conclusion that both, sorry, just by looking at this 50% or 51% or 55%, we should not conclude that both the parties or one party has the control. We have to see how much percent is needed to decide on the particular matter. If that answer is one of the party can do it, then one party has the control over it. Okay, but if we need the voting of both the parties, then there is a joint control. So when we say joint control, consent of both parties or all the parties, more than two parties, is needed. Right now, say for example, we have three entities, A, B and C. A has 50%, B has 30%, C has 20%. A has 50%, B has 30%, C has 20%. Now tell me one thing, if I need 75% voting, then who has control? Can I say A alone has control? I cannot say, because it's only 50%. Can I say A and B has control? Yes, A and B together can jointly get to 75%. Can A and C come together and control? No, C is not needed. Even if C says no, even if C cries, dies, whatever C says, with A and B we can control this entity. So A and B have joint control, C does not have any control. Sir, if C comes and votes, we get 100%. That is okay. We have to see the threshold at which these two entities can come together and make a decision, right? So that is where we have this A and B coming together and having a joint control. Okay. Now X, Y and Z. Let us say X has 50%, Y has 25%, Z has 25%, and you need 75% stake. Now in this case you need 75%. Now in this case X and Y can also control, X and Z can also control. Okay, but X is needed. But can I say X alone controls the arrangement? X alone doesn't control the arrangement. But X and Z can control, X and Y can control. So there is a control exercised by all three together, or either X and Y or X and Z. Now how do we get to know? We have to look at the contractual, or the way they are behaving, or the kind of arrangement they have between the parties. Okay, in this situation I can have X plus Y also, I can have X plus Z also, or I can have X plus Y plus Z also. So depending on the circumstances, the contractual arrangement, we can decide whether X and Y control or X and Z control, or all three control together. Now coming back to the definition part, What is a joint arrangement? A joint arrangement is an arrangement, means some form of coming together, doing some business and all of that, of which two or more parties have joint control, means there are two or more parties who jointly control the arrangement. The characteristics of joint arrangement are: there is a contractual arrangement, there has to be a contractual arrangement, we cannot rely on implied arrangement, there has to be a contractual arrangement, and the contractual arrangement gives two or more of those parties joint control over the arrangement. Okay, so there has to be a contract, necessarily two parties coming together deciding that yes, we will do particular activities or particular aspect, and then saying that okay, we have entered into a contract, and two or more than two parties jointly decide about what? About the relevant activities of the entity. That is when we say there is a joint control. Okay, is it clear so far? Now, joint control is the contractually agreed sharing of control of an arrangement which exists only when decision about relevant activities require the unanimous consent of the parties sharing the control. As we said in the example, A and B both have to agree. Only then the decision can be taken forward. So in that case, A and B together have joint control. Right. Now, when we talk about types of joint arrangement, it can be either a joint operation or a joint venture. Now, how do we distinguish between a joint operation and joint venture? And it is important to distinguish because accounting is different in case of a joint arrangement, joint venture and joint operation. Okay, so whether there is a joint operation or a joint venture, that is what we need to decide, because if it is a joint operation, then we will have one type of accounting. If it is a joint venture, then we will have another type of accounting, because how to account for it depends on whether it is a joint operation or a joint venture. Now, what is a joint operation? It is a joint arrangement whereby the parties that have joint control of the arrangement have rights to the assets and obligation for the liabilities relating to the arrangement. These parties are called joint operators. Now, what does this mean? This basically means that whenever I am saying that there is a joint arrangement, I have right to assets and obligation for the liabilities. Meaning to say, if say for example this is A Limited, I have B Limited. Okay, A Limited and B Limited. They form a joint venture called AB Limited, each holding 50-50. Right? Now, tell me one thing. If AB Limited, we all know it is a separate entity. Now, tell me one thing. Who is responsible for assets and liabilities, or who has the right to assets and liabilities of AB Limited? Can I say A Limited and B Limited have 50-50% stake in asset and liability, or because it is a separate entity, only AB Limited has the assets and liabilities in its name? Meaning to say, if there is a liability, who will settle? These liability holders, will they come to B Limited or will they go to AB Limited? If for example some default happens, whom will they approach? Will they approach AB Limited or will they approach the A Limited or B Limited? In such scenarios, because AB Limited is a separate entity, the assets and liabilities, assets are enjoyed by AB Limited, liabilities are also settled by AB Limited. The entity does not have the entities to the party or the the parties to the joint arrangement. They do not have right to the assets and obligations for the liabilities. So if there is a separate vehicle, generally most of the times it is a joint venture. It is a joint venture. So in case of joint arrangements, parties have rights to assets and obligations for the liabilities. Meaning to say for example A Limited and B Limited, they come together and they agree to explore oil. They did not form a separate entity. If they form a separate entity, then it becomes a joint venture. If they have not formed a separate entity, this is called a joint operation. Now, when they have not formed separate entity, if this project there is some liability, then A is also liable, B is also liable to the extent of their share. There is no separate legal entity concept. The moment there is a separate legal entity concept, then the entity, there is a separate entity, and that becomes a joint venture. But if there is no separate entity, just they have come together to explore oil. For example, liabilities, A is also liable, B is also liable. In that case, we say it is a joint operation. So, in case of a joint operation, we have rights to assets and obligations for the liabilities relating to the arrangements, and the parties are called joint operators. Now, the second category is joint venture, where parties have joint control of the arrangement, have right to the net assets of the arrangement. These parties are called joint venturers. Now, in case of joint venture, an outsider liability, for example, let me put in a separate note. For example, Reliance Tata. They came together and formed Reliance Tata Limited. Okay. Now, the liabilities of this entity is to be borne by Reliance Tata Limited. Reliance and Tata cannot be directly held responsible for the liabilities. Or Reliance cannot say assets belong to me, 50% assets belong to me. Tata cannot say 50% assets belong to me. That cannot happen. So, what happens in this situation? This is called a joint venture. In case of a joint venture, Reliance and Tata, they will get share in net assets when at the time of liquidation or whenever dividends etc. are being declared. So, if you see a separate entity, then let me erase all of this. If you see a separate entity that they have joint control and they have rights to the net assets, then this is a joint venture. So, if the joint arrangement is structured through a separate vehicle, then by looking at the legal form of the separate vehicle, contractual arrangements and other facts and circumstances, normally this is called this becomes a joint venture. Otherwise, it will become a joint operation. Are we clear? Now, if there is a separate vehicle, then if for example it's a partnership. Now, in case of a partnership, because a partnership has unlimited liability, the liability will fall back on the companies, and hence you can say it is a joint operations. Whereas if it is a separate entity, it's a separate vehicle, then it will become a joint venture if, let us say, it is a company form of organization or it is a limited liability partnership. In those situations, it becomes a joint venture. But if there is a separate vehicle, if there is no separate vehicle, then it is always a joint operation. If there is no separate vehicle, then it is a joint operation. I hope it is clear now. So, to summarize, no separate vehicle. Vehicle here doesn't mean your car or something. It's basically an entity. This is a joint operation. Other cases, it will be a joint venture depending on the facts and circumstances of the case. Any questions so far? Now, the thing that we need to understand is, if it is a joint operation, then the entity will recognize share of assets, share of liabilities, share of income, and share of expenses. So, whenever there is a joint operation, what you will do, you will take the share of assets, share of liabilities, share of income, and share of expenses. That is what will be recognized. Okay. Now, if it is a joint venture, we will follow equity method prescribed under Ind AS 28. So, as per Ind AS 28, we will prepare, or we will, see the equity method when we learn about investment in associates and all of that, and accordingly we will account for it. But if it is a joint operation, both in the standalone financial statement as well as in the consolidated financial statement, we will recognize all share of assets, liabilities, income and expenses, whatever is our share. If our share is 50%, so whatever is the 50% of assets, we'll put it in the balance sheet, 50% of liability in our balance sheet, 50% of this also will be put in the balance sheet. That is how we will account for the joint operations. If it is a joint venture, we will follow the equity method prescribed under Ind AS 20. So let's have a look at a question. Just a moment. So let's have a look at this question. P and Q, they form a joint operation, and in the question will be given, or sometimes they will say whether it's a separate vehicle or not. Okay, P and Q form a joint arrangement PQ using a separate vehicle. P and Q own 50% of the capital of PQ. However, the contractual terms of the joint arrangement states that P has the rights to all the machinery and obligation to pay bank loan. P and Q have rights to all other assets and obligations for all the liabilities in the proportion of the share of capital. Now, generally we said if there is no separate vehicle, then it is a joint operation. If there is a separate vehicle, then we will evaluate whether it is a joint venture or a joint operation. Okay, now here the structure says that they have the share or they have the obligation to pay bank, they have the right to all other assets and obligations, which means looking at the contractual terms, we can say that it is a joint operation. Now, when it is a joint operation, whatever is there in the PQ balance sheet, you will account for using this. So 50% here of the capital, then they own 50%, then they said P has the rights to all the machinery. So here entire machinery will be accounted by P. Then bank loan it has, so bank loan also will be accounted by P, and the remaining will be accounted by 50, 50, 50, 50, 50. Okay, now how will they account for it? P will record the following in its balance sheet. Now P will record entire 250, this 250 will be recorded. Then P will record 50% of the cash, because it controls 50% of the asset, or it has right to 50% of the asset. So debit machinery, debit cash. Now this capital entry, this is incorrect, which is given in the study material. This is not correct. Okay, you will not account for capital, saying it as capital. Whatever is the balancing figure, you will account for it under other equity. Right. So this is incorrect. Some of the faculties also have taught it this way, but you will not credit capital when you are accounting for assets and liabilities. Okay, you will not say share capital, whatever is there, 50% I own. That is not how you account for a joint operation, right? Then bank loan 75,000 fully they will recognize, other loan 37,500 they will recognize. So you will credit this and credit this. Whatever is the difference, you will credit to other equity in the consolidated financial statement. Are we clear? Good evening, Nisha. No worries. Glad you joined. So this is how you will account for the amount. So 250 plus 25, 275 minus 75 minus 37.5, whatever is there, you will credit under other equity. Same thing here also. So here also they have to take under equity. Okay, the balancing figure. So here if you see, AB and BC Limited have established a joint arrangement through a separate vehicle. The legal form of the separate vehicle does not consider separation between the parties and the separate vehicle itself. So something like a partnership where there is no separate legal entity concept. Thus both parties have right to the assets and obligations for the liabilities of PQR. As neither the contractual terms nor the facts and circumstances indicate otherwise, it is concluded that it's a joint operation. Both parties own 50% each. However, contractual terms state that AB has rights to all of building 1, entire building 1, 240. Then, obligation to pay all the debt owned by PQR. So, all the debt 240. Oh, surprising, both of them are 240. So, 240 and 240. Then, AB and BC Limited have rights to all other assets and obligation for all other liabilities of PQR in proportion of their interest. So 50%, 50 here, 50 of cash here, so 20 here and 100 here. So 100, 20 minus 50. So 70 is your equity component. Okay. You will not say share capital, it will be equity. You will not recognize share capital of a joint. So like this what they have said here. This is nonsense, to be frank. You will not recognize capital. You will not recognize capital of another entity. You will not recognize capital of another entity as capital. You will say equity, and this number is also incorrect as I told you. Now, whenever you have a joint operation, for example, Reliance and Tata, they started a joint operation. Sometimes what happens is, let us say Reliance, Tata. Okay, joint operation, they will say 50% stake. Now, Reliance procured some machinery, or Reliance sometimes sold goods, or Reliance sometimes, invested amount directly. So how do we account for it? So whenever we account for it, we will account to the extent of our share, and balance will be receivable. For example, Reliance, Tata. Okay. Now Reliance has, let us say, 50% ownership, 50% ownership. Reliance spent 100 crores to acquire an asset for this particular joint operation. Reliance spent 100 crores. Now in Reliance books, what Reliance will do is, out of this 100 crores of asset, what is my share? 50%. So Reliance will say asset debit 50 crores. Cash credit, cash means cash or bank, 100 crores because we have paid 100. Now the balance 50 is recoverable from Tata. So we will say Tata debit 50 crores. Now what will Tata do? Tata will say asset debit 50 crores, Reliance credit 50 crores. This is how accounting will be done when they make expenses on behalf of other joint venturers. Now sometimes what happens is, one party sells asset to the joint venture or for the joint venture. Here we said Reliance procured, but now Reliance may sell its existing asset to the joint arrangement. In that case, how the accounting is done, let us have a look at it. A Limited is one of the parties to a joint operation holding 60% interest in a joint operation, and the balance 40% interest is held by another joint operator. Now you might say, sir, how 60% and 40% would be joint control? Maybe they need 60% or they need 70% and all of that. Okay, so 60% and 40%. A Limited has contributed an asset held by it. So who held that asset? A Limited held the asset, and it contributed to the joint operation for the activities to be conducted in joint operation. Carrying value of the asset is 100, and asset was actually sold for 80. There is a loss of 20. How should A Limited account for the sale of asset to the joint operation in its books? Now here what has happened is, you see, I have an asset which is having a carrying amount of how much? 80. Sorry, carrying amount of 100. I have an asset which is carrying amount of 100, and 80 is the sold value or transaction value. I have something worth 100, I have sold it at 80. I have something worth 100, I have sold it at 80. Now, out of 100, when I give that asset to somebody, now the other party in the joint venture, I have 60% ownership, the other party has 40% ownership. I have 60% ownership, the other party has 40% ownership. Correct or not? I have 100 of carrying amount. Out of this 100 of carrying amount, I still control 60%, but I have sold 40%. I still control 60%, but I have sold 40% to other party. I have sold 40% to other party. Now, if I have sold 40% to other party, basically I will de-recognize 40 of asset. I will de-recognize 40 of asset. I will de-recognize 40 of asset. So, if I put it in the balance sheet, this will help you understand it better. In the balance sheet, I have 100 of asset. What I am saying, I have given it to the joint operation at whatever value. From this joint operation, I will again get back how much? 60%. So can I say 60 is what I have retained and 40 is what I have transferred? So I have moved out 40 out of the balance sheet, right? Then from the joint operation, I should receive, or I will receive, whatever is the cash component. My share is how much? 60%. Now how much did the joint operation say? Joint operation, if you see, they have paid 80 for me. Joint operation paid 80 for me, or 80 for the machine. Now out of this 80, I already control 60%. I already control 60%. Correct? I already control 60%. Then the balance 40% is what I am getting from my partner's share. So that is how we have to understand. I have whatever the joint operation pays, 60% is my own money. So how can I sell the asset to myself? To that extent, I'll say, okay, it is my own asset, it will remain with me only. Whereas 40% belongs to the other party. So whatever 80 is paid out of this 40%, that is 32 is what is received by, or what is technically transferred to me. I am repeating once again. If you see the joint operation, bank balance, let us say 80. Out of this 80, let us say this joint operation transferred 80 to me. Out of this 80, 48 is already there in my balance sheet. What I will get fresh is only 32. What I will get afresh is only 32. So I will debit bank 32, credit asset 40, debit loss on sale. I am recognizing loss. In other words, I am recognizing loss. What is the total loss? 20 is the total loss. I am recognizing loss only to the other party share, not my own share, because I will not recognize a loss by selling the asset to myself. So to the extent of my share, I will not recognize any loss. Is there any clear? Is there any confusion? Now, some of you may have a doubt, sir. Can we not recognize the balance 12 crores as loss by by applying the prudence concept? I cannot make a loss by transacting with myself. So that is the whole concept. Clear? Okay. Clear. Great. So these type of questions can be tested for 4 marks to 6 marks and similarly. Then let us see another one. Now here, purchase of assets from a joint operation. A Limited is one of the parties to a joint operation holding 60% in the joint operation and 40% is held by another joint operator. Sorry. A Limited has purchased an asset from the joint operation. Carrying value of the asset in the books of joint operation is 100 and the asset was actually purchased for 80. How should A Limited account for the purchase of the asset from the joint operations in its books? Now what has happened? Again, I'll do it here because I need some more space to write. Okay. Now here what has happened? Here there is an asset worth 100. Now A Limited will anyways show asset saying 60 and let us say B Limited is the other party. They will say asset at 40. Now what has happened? A Limited has purchased the asset. A Limited has purchased the asset. Now when A Limited has purchased the asset, what A Limited is doing is, A Limited is saying I will pay from cash. A Limited is saying I will pay 80. I will pay 80. Who gets 80? The joint operation gets 80. And this asset of 100 is moved here. The asset of 100 is moved here. Okay. This is the carrying amount. Now I paid 80. I paid 80. Out of this 80, what is the amount I will recognize again? I will say 60% is my share. So I will say cash of 48 again back in the books. So in other words, can I say I paid net amount of 32? That is 40% of the value is what I have to pay. 60% is anyways my share. So I will not be paying myself for my share. So what I will say 40% is what I have to pay. 80 ka 40% is 32. So 32 is what I have paid out. Now what is the value of asset that I will bring in? See, currently I am recognizing it at 60. Currently I am recognizing it at 60. For the balance 40%, what is the value? Out of 80, 40%, 32 is the value. So I will say asset debit 32, cash credit 32. So net amount paid 32, and whatever I have got, your asset of 32. So why asset of 32? See, the JV is the joint operation is selling asset worth 80 at 80. 60% is already with me. 40% is of B Limited. I am buying only this 40% stake. That is why only 32 is accounted for. Okay, so that covers joint operation. Now we talk about Ind AS 28, which deals with investments in associates and joint ventures. That is to do with equity method of accounting. Equity method of accounting. Now, what is equity method of accounting? I will give you a very simple example again. All of you would have heard about partnership accounting. Thanks, Abhishek. Thanks a lot for the comments. That actually motivates me. Nisha, is your doubt clear? The asset value being 100. See, if the asset value is 100, 60% I am anyways saying it is my asset. I cannot sell my own asset to me. I am only buying 40% asset which is held by the other party. And the cash flow also I told you. Even though I am paying 80, I have already 60% of that is from my own pocket. Means I have already recognized that as my asset. Okay, I hope it is clear. Yes. Now we'll move to associate accounting. The most important part being equity method of accounting. Now, equity method of accounting, what you need to understand here is simple. You would have heard of partnership accounts. You have run partnership accounts, right? At 11th, 12th, foundation, BCom, inter, correct? Same concept works in equity method of accounting. Now, what do I mean by that? If there is a partner in the books of partnership, whenever capital is contributed, what is the entry we pass? If let us say this is A capital account. A contributed 1 lakh to the firm. What is the entry we pass? If A contributed 1 lakh to the firm, we will say by bank 1 lakh. Correct? And in A's book, what A will say is, I have something called investment account. I will say to bank, because I have paid 1 lakh, to bank 1 lakh. Then for the period, the partnership earned, let us say profit of 2 lakhs or 50,000, whatever it is. My share or A's share is 20,000. So you will say by P&L 20,000. In the books also, what you will say, investment in partnership to P&L, because I'll recognize the gain. How much? 20,000. Then withdrew money, drawings to bank 10,000. Here you will say by bank I have drawn money 10,000. What is my closing balance? 1 lakh 10,000. This, my dear friends, is nothing but the equity method of accounting, where you take the initial capital contribution, add all share of profit, deduct all share of losses, less any dividends. Now here I am saying drawings. This takes the form of dividends paid. That is what will give you the investment or the equity method of accounting. If you remember this concept, accounting for under equity method is not at all challenging, right? Now coming to the associate, see, so one more thing, I'll just write it down here. If there is control, you have parent and subsidiary. If it is control, you have parent and subsidiary. If there is joint control, you have joint operation or joint venture. But if you do not have control, if you do not have joint control, but you have something called as significant influence, which is you check this 20% ownership criteria or 20% voting rights criteria. If there is this significant influence, we call it associate. We call it associate. Now, what is an associate? Associate is where one entity has significant influence over an investee. What is significant influence? Significant influence is the power to participate. When we have power, we control. When you have power to direct the relevant activities, we control. But here we are saying we have the power to participate in the financial and operating policy decision of the investee, but is not control or joint control of those policies. Meaning to say, I have power to do what? I can participate. I have power to do what? To participate. But can I control? No. Can I decide? No. Am I jointly controlling with somebody? No. In that case, what I have is significant influence. And when one investor has a significant influence over the investee, then we say that there is an associate of the investor. Now, what are the criteria? If an entity holds directly or indirectly through a subsidiary 20% or more of the voting rights, we will presume that there is a associate relationship. There is an associate relationship, and if there is less than 20% of the voting rights, then we will presume that the entity does not have significant influence unless we can clearly demonstrate. Meaning to say, if I have 20% or more stake in another entity, I will presume that I have a significant influence, and hence there is an associate relationship. If there is less than 20%, I will presume that there is no significant influence, and hence there is no associate relationship. Otherwise, I have to prove. Okay, so how do I prove? Maybe by way of representation on the board of directors or governing body. Now, if I have control over the composition, then I say there is control. But here I am just having representation. I can participate in the policy making process, material transaction, interchange of managerial personnel, provision of technical information. Something I can say that yes, I can influence the other party, the decision making of the other party. Then in that case, we say that there is a significant influence. You also consider potential voting rights which are currently exercisable. Now, whenever we talk about an associate, we apply something called as equity method of accounting in the consolidated financial statement. Sir, what do we do in case of the standalone financial statement? In standalone financial statement or the separate financial statement, you will follow the normal method as prescribed by Ind AS 109. Okay, if you follow the fair value through P&L or fair value through other comprehensive income, you will consider it that way. Whereas you will apply equity method in the consolidated financial statement. This is applicable to both joint venture and associate. Okay. Now, what is equity method? You will record the investment at cost, record the investment share in the P&L of the associate after the date of acquisition, recording investment shares of OCI, and distribution of dividend received. Like I showed you the partnership capital account, we will take one problem also. You will record all of this in the consolidated financial statements. Now, exemption for applying equity method, similar exemptions that we have learned in consolidation that can be applied. So, we can have a look at it. Now, another important aspect here is upstream and downstream transaction. Now, whenever there are upstream and downstream transaction, for example, entity sold to the associate or entity sold to the joint venture. Now, in that case, or you purchase from associate. So, what are we saying? We anyways are saying that we will account for investor shares of profit and loss. Indirectly, we will account for net assets. Indirectly, not directly. Indirectly, we will account for net assets because whatever I have invested plus whatever is my share of profit, I have accounted for it indirectly in the by way of net assets. Okay. Now, what we have to do is whenever there is an upstream or downstream transaction, then we will record the gain or loss only to the extent of unrelated investors' interest in the associate or joint venture. Meaning to say, if I own 20%, this 20% of gain I will not recognize. 20% of gain I will not recognize. Sir, why? If I recognize this 20% of gain, indirectly I am recognizing a gain with the transaction with myself. So, you will record the gain or loss only to the extent of unrelated investors' interest in the associate or joint venture. The gain or loss attributable to the entity will be eliminated. Right, so let us have a look at few questions that will make our understanding slightly better. Just a moment. These examples of significant influence, you can have a look at it on your own. Yeah. Okay. So let's have a look at this question. Illustration number 10. Okay. Blue Limited acquired 25%. More than 20% means it is definitely an associate, we will presume it, of the equity share capital of Green Limited on the first day of the financial year for 1,25,000. So initially we will record at this cost. As of that date, the carrying value of net assets of Green Limited was 3 lakhs and the fair value was 4 lakhs. The excess of fair value over the carrying value was attributable to one of the buildings owned by Green Limited having a remaining useful life of 20 years. Green Limited earned a profit of 40,000 and OCI income of 10,000 during the year. Calculate goodwill and capital reserve on the date of acquisition. Blue Limited share in profit and other comprehensive income for the year and closing balance of investment at the end of the period. Now, what you have to understand here is, so there is no enough place to calculate. I just orally explain this to you. Purchase price or consideration that we paid is 1,25,000. So, cost of acquisition is 1,25,000. Right? That is the amount that has been paid. Then, share in the fair value of net assets is 25% of 4 lakhs, that is 1 lakh. So, 125 minus 1 lakh, 25,000 is the goodwill. This goodwill will not be recognized. We will assume that this goodwill is already included in the investment. See, in case of consolidation of subsidiary, we eliminate the investment and we separately account for individual assets and goodwill. Here what we are saying is, this 125 and 1 lakh, the difference of goodwill 25,000 is included in this 1,25,000. Okay, so you will not account for goodwill separately. You will just say cost of acquisition of investment including goodwill of 25,000 is 1,25,000. Then they made a profit of 40,000 during the period. Now out of 40,000, our share is how much? 25%, which is 10,000. Our share is how much? Which is 25%, which is 10,000. Now, please understand that when we are valuing the assets of the subsidiary of the associate, we said it is how much? Extra by 1 lakh. So 1 lakh of asset is extra in terms of fair value at the associate. Now on this 1 lakh, what is the additional depreciation? Additional depreciation is 1 lakh divided by 20 years. 20 years, that is 5,000. But do I own the entire 1 lakh? I don't own. So of this, my share is how much? 25%. So 1250 is the additional depreciation that I should be providing. 1250 is the additional depreciation that I should be providing. Sir, why are you providing this additional depreciation? Because I have acquired the associate. There I said the fair value of the net asset is how much? 4 lakhs. That is where I said this 1,25,000 has a goodwill of 25,000. In other words, this 1,25,000 includes, the fair valuation made of 4 lakhs, and of that 25% 1 lakh. So this includes here. Otherwise, my goodwill component would be slightly higher, right? Now, because I have said that asset value is higher, I am saying extra 1250 of depreciation impact should be given. The same way we give in case of a subsidiary. So my net profit becomes 8750 and OCI share is 2500. So initial investment plus 8750 minus 122500 and 136250. Right. So that is how we value the net assets. Another reason why I have excluded depreciation is my net asset is at fair value here. This is all at fair valuation. So when it is at fair valuation, the depreciation impact should also be given and accordingly given. Now, looking at upstream and downstream transaction, M Limited has invested any doubt? Okay. Now, upstream and downstream transaction between an entity and its associate. This is very important. M Limited has invested 40% share capital of N Limited and hence N Limited is an associate. During the year, N Limited sold inventory to M Limited for a value of 10 lakhs. This included a profit of 10% on the transaction price, profit of 1 lakh. Out of the above inventory, M Limited sold inventory of 6 lakhs to outside customers. Hence, the inventory of 4 lakh purchased from N Limited is still lying with M Limited. Determine the unrealized profit to be eliminated from the above transaction. See, if it is a realized profit, anyways we have sold to third parties, there is no problem. Now here what happens is, please understand, we have unrealized inventory of 4 lakhs. We have inventory of 4 lakhs. In this 4 lakh, how much is the profit? See, the profit is 10% on the transaction price. So 10% is the profit. 10% is the profit. So 4 lakhs into 10%, 40,000 is the profit. 4 lakhs into 10%, 40,000 is the profit. Right. So this 40,000 of profit that we have, 40,000 of profit that we have is pertaining to the 100% share. Correct or not? 40,000 of profit that we have pertains to 100% share or 100% inventory. Correct. Now, when I am saying that my share or my entry or my realization is only how much? 40%. My realize is only, my share is only 40%. Now, if it is 40%, 40% of 4 lakh, 40,000 is how much? 16,000. So, 16,000 of profit or 16,000 of profit is not yet realized. 16,000 of profit is not yet realized. Now, who sold to whom? M Limited. So M Limited has invested in Limited. M Limited has sold inventory of N Limited sold inventory to M Limited. So here N Limited, which is the associate, sold inventory to M Limited. N Limited sold inventory to M Limited. Who is M Limited? M Limited is the investor. Okay. Now in M Limited books, we have inventory of 4 lakhs. In M Limited books, we have inventory of 4 lakhs. This 4 lakhs this 4 lakhs is received from whom? From N Limited, where there is a profit component of 40,000. Where there is a profit component of 40,000. So whatever is the profit component, this is one element in my inventory. I am holding it together totally. Now this, if you ask me, my share being 40%, I have to eliminate 16,000 of profit. I have to eliminate 16,000 of profit. But whose profit? 16,000 of profit of N Limited, because N Limited has made the profit. I'm just highlighting in a different color. N Limited has made the profit. Out of the profit made by N Limited, what is my share? My share is 16,000. So I cannot recognize the profit. Otherwise, what I will do? The entire 40,000 of profit or entire profit on sale of inventory, indirectly I would have added when I add the profit of my share of profit in the associate. So to the extent of 16,000, is not my profit, is a profit which is still not realized. It is the amount which is attributable to me. So I will reduce the inventory value by 16,000 and I will bring that amount of 16,000 to by inventory by 16,000. So whatever inventory I have, I will reduce this 16,000 component, because that is a portion of profit which is pertaining to me, which is unrealized. Are we clear? Are we clear? Now, when this 1 lakh profit is made, what is my share of profit? I have accounted here 40,000 as my share of profit. I will increase the investment value and I will say share in profit 40,000, because that is the total profit that I have earned in this transaction. So I will increase the investment value and I will show share in profit. Whereas out of this 40,000, because 16,000 is unrealized, I will eliminate that by reducing it from the inventory. I hope it is clear. Scenario B. Assume the same facts as per scenario A, except that inventory is sold by M Limited to N Limited. Now who is selling? M is selling to N. Who is selling? M is selling to N. Now when M is selling to N, what happens? When M is selling to N, what we need to understand is, out of 10 lakh of sales, 4 lakhs is still not sold by the associate to outsiders. Out of 10 lakhs, 4 lakhs is not yet sold by associate to outsiders. Means 4 lakh is still lying in the inventory of associate. 4 lakh is still lying in the inventory of associate. Now, when 4 lakh is still lying in the inventory of associate, again here, how much is the unrealized component? Unrealized component is 16,000, same number. But now tell me, here I reduce inventory. Why did I reduce inventory? Because inventory is in my books. M Limited has inventory. So, inventory is in my books. That is why I reduced inventory. But in the other case, inventory is not in my books. Inventory is not in my books. What is there in my books? I am indirectly accounting net assets in the investment account. So, this investment part I will credit. So, remember this, when the investor, just a second, it's again charge off. So I'll just repeat that for you. If the investor is selling to the investee, If the investor is selling to the investee, investor does not have inventory in its books. So that 16,000 is eliminated from the investment. So why are we eliminating it from the investment? Indirectly, we are eliminating it from the net asset. That's the first thing. Second thing, if the associate is selling to the investor, investor has inventory in its book, we will reduce from the inventory. If the associate is selling to the investor, investor has inventory in the books, so we are reducing it from the inventory here, because M Limited has inventory. M Limited has inventory. In the second scenario, M Limited does not have inventory. Who has inventory? N Limited has inventory. So I am reducing investment. Indirectly, I am reducing the net asset. Sir, what is this 1,60,000 and 144? See, 4 lakhs is still with the associate. Out of this 4 lakhs, 40% is my account. So 1,60,000 of sale and 144 of cost of goods sold I am removing from my books. Sales and cost of goods sold or cost of material consumed. Otherwise, when I made the sale of 10 lakhs, I credited entire amount to sales. When I made a sale of 10 lakhs, I credited entire amount to sales. Out of that, I am saying 4 lakh is not yet sold. Out of that 4 lakh, my component or my share is 1,60,000. So 1,60,000 sale, I will reverse. Cost relating to that, I will reverse. And whatever is the unrealized profit, 16,000, I will reduce from the inventory. So these are two scenarios where you have, investment in associates and there is a downstream and upstream transaction. Okay, now we'll look at another specific aspect, which is loss making associate or joint venture. Very important. Now, whenever I am looking at a associate or joint venture, what did we say? We said that whenever we account for associate, we will take investment plus profit minus losses minus dividends. Okay, minus dividends. Now, if the share of loss exceeds my interest in the associate, for example, if investment is 1 lakh, profit is minus 1,50,000, it becomes my share. So the question is, to what extent should I recognize the loss? To what extent should we recognize the loss? Now what it says is, to the extent of your net interest, whatever is the loss, you can recognize. Now net interest here means not only my equity investment, but any other investment. Where I have made contribution to the to the associate, for example, by way of preference shares, by way of long-term receivables, not trade receivable or trade payables, any other form of contribution, equity, preference and long-term receivables or loans, that is called my long-term interest. So for example, if I have equity of 100, preference of let us say 25 and other receivable of let us say 25. So my interest in is 150. To the extent of 150, I can recognize loss. Beyond that, I will not recognize the loss. Okay, so this we can understand better with an example. Very important. You can mark it as important. An entity has following 3 types of interest in an associate. Equity shares, 25% of the equity shares to which equity method of accounting is applied. Preference shares, non-cumulative preference shares that form part of net investment in the associate. So they are a part of my net investment. Preference shares are measured at fair value. Long-term loan carrying interest of 10%. Interest income is received at the end of each year. Long-term loan is accounted as per the amortized cost method of Ind AS 109. This also forms part of net investment. So I have 25% share, preference shares and long-term loan. At the start of the year, the carrying value of each of the above interest is 10 lakhs, 5 lakhs and 3 lakhs. So this is the total interest. Now, following table summarizes the changes in fair value of preference shares as per Ind AS 109, impairment loss on long-term loan as per Ind AS 109, and share of profit and loss in the associate. So first, 50,000 decrease in preference share value, again 50,000 decrease in preference share value, then 1,50,000, 30,000 increase in preference share value. Impairment loss, reversal of impairment loss, share of loss 16 to 10 and 10. Now, what you have to do is, first all of these three you have to account as per Ind AS 109 and then you will account for losses. Okay. Now, in year 1 what happened? I have equity of 10 lakhs, preference shares of 5 lakhs, long-term loan of 3 lakhs. I have equity of 10 lakhs, preference shares of 5 lakhs and long-term loan of 3 lakhs. Now, first I will check Ind AS 109 scenario. 50,000 loss here, 50,000 loss here. So, write that off. 50,000, 50,000. After the loss, the balance is how much? 17 lakhs. Balance how much? 17 lakhs. Now, what the standard says is 17 lakhs is my balance. But if you see, my equity investment is only 10 lakhs. What is my share of loss? My share of loss is 16 lakhs. So, the standard says the entire 16 lakhs you have to adjust from equity, preference shares and long-term loan. First, you will write off equity because that is the last one who will receive the money. Entire 10 lakhs is written off. Then, preference shares, whatever is the balance, entire balance is written off because preference share will also not get if the entity goes into liquidation. And long-term loan will get 250 minus 150, 1 lakh becomes the balance, right? So, even though my share of loss exceeded the equity, component, I will still recognize this loss of 10 lakhs, 4 lakh 50 and 1 lakh 50, total loss of 16,000 to the extent of my net investment. Okay, then in year 2 what happened? In year 2, my opening balance is 0, 0, 1 lakh here. Then preference shares loss of 50,000. Preference shares further loss of 50,000, which means negative closing balance of 50,000. Now, can I have a negative closing balance? I cannot have negative closing balance. Hence, what I will do, I will reverse the 50,000 portion, or let me just a second question if I come back. Loss is of 2 lakhs. Loss is of 2 lakhs. Now, out of these 2 lakhs, out of that 2 lakhs, please understand, I have 1 lakh of balance. I have 1 lakh of balance in the net investment account. Out of this 1 lakh of balance, first I will use 50,000 to write off my preference shares. How much am I left with? I am left with another 50,000. Only to the extent of 50,000, I will be able to recognize the loss. Meaning to say, 1 lakh is my carrying amount, opening balance. Adjustment as per Ind AS 109, 50,000 I have to reverse. I don't have balance in preference shares account, so I will borrow from the long-term loan balance, 50,000. So 50,000 will be written off, and the balance 50,000 will be used for loss writing off. After that, all my balances become 0, right? Then in year 3 what happened? In year 3 what happened? There is an increase in preference shares by 1 lakh, impairment reversal 50,000, and there is no profit or no loss. There is no profit or no loss from the entity. Now in that case what happened? 1 lakh I have to increase the preference shares. So I will increase the preference shares by 1 lakh, and I will increase the preference share by 1 lakh, long-term loan by 50,000 as increase in fair value. Now, here if you see, 16 lakhs was accounted for there, and in the second year, first year 16 lakhs of loss was accounted, second year 50,000 of loss was accounted. So I have 1,50,000 of loss balance. That loss balance I will utilize it to again account for it against my net assets. So my closing balance becomes 0. Then this is previous losses. In year 4 what happened? Preference shares got upward valued by 50,000. Then you have share in the associate. Now that share in the associate, how will I account for it? See, first I wrote 3 lakhs, 5 lakhs, 10 lakhs is there. So first I will restate my loan because that is a first rank creditor. So loss of 3 lakhs, first I'll account for here. Then preference shares. What was the valuation of preference shares? 5 lakh was the valuation of preference shares plus minus 50, minus 50, 1 lakh and 50. So in year 4, my preference share balance should be 50, 50 and 1 lakh gets knocked off. 5 lakhs plus 50, 550. So I'll bring the preference shares valuation to 550 by reversal of this and share of profit. And then balance amount I'll recognize in equity. So this is the balance at the second year. Then in the third year, whatever is the profit that has come, entirely I will add it to equity and the accounting continues. Are we clear? This is one question. You have to again have a look at it so that you have absolute clarity. Now, please note impairment for goodwill in carrying value will not be tested separately for impairment because goodwill is anyways not accounted for separately. Goodwill is considered to be a part of the investment that we have accounted for. Now, if an investment becomes a subsidiary, then whatever is the fair value on the date of the associate becoming a subsidiary, that will be, whatever is the amount. So, for example, whatever is the carrying amount versus whatever is the fair value, difference is accounted for in the P&L. Accounting for joint operations we have already seen. Accounting for joint ventures we have already seen. We will again follow the associate method, equity method of accounting only. Now, Ind AS 27 talks about separate financial statements. Any questions so far? Year 2 once again. Okay. In year 2, first we will write off the impairment loss, whatever happened as on the preference shares. That is 50,000. Let me erase this. So here if you see 5 lakhs minus 50,000 is what we did, 450, and we took it from the share of loss 450. Now what we are saying, there is further impairment loss, so we have to recognize this impairment loss. Now do I have the balance to recognize impairment loss? No. So I will use the balance from the profit. So whatever was the profit loss there, I will reverse that amount, and the balance part, the net 50,000 of loss is what will be recognized. So first I will recognize provisions of 109 and then I will come to recognize the share of loss from the subsidiary. So 50, then again 1 lakh is the value of this, the entire 1 lakh will be written off. Net loss that I will recognize is 50. So out of 16 lakhs plus 2 lakhs, 18 lakhs, I have recognized 16 lakhs 50,000. 1 lakh 50,000 is recognized in the third year. Now, moving on, we have Ind AS 27, a very small concept, separate financial statement. Now, this separate financial statement basically it prescribes the accounting and disclosure requirements for investment in subsidiaries, joint venture and associates when an entity prepares separate financial statement. Now, what is separate financial statement? Separate financial statements are those which are presented by a parent, an investor with an investment in an associate or a joint venture. So, either a parent, it is preparing its separate financial statement, or an investor with investment in an associate or JV. So if there is an investor who has investment in associate or a JV, this investor prepares a separate financial statement. Now, who will prepare separate financial statement? That is governed by the statute. That is governed by the statute. You and I don't govern, or Ind AS doesn't govern that. Separate financial statements are in addition to consolidated financial statement, or In addition to financial statement of an investor that does not have investment in subsidiaries but has investment in associates, joint ventures, in which investment in associates or JV are accounted for using the equity method. So, separate financial statement is something which is prepared in addition to CFS or any other financial statement which has associate under the equity method. Now, in the separate financial statement, it will account for investment in subsidiaries, associates, and joint venture in one of the following ways: either at cost or in accordance with Ind AS 109. Now, what does Ind AS 109 say? Either FVTPL or FVTOCI. If an investment entity is having investment in other entities, then it will measure investment in subsidiaries at fair value through P&L as per Ind AS 109. So this is one thing you have to keep in mind. Investment entity will follow fair value through P&L as per Ind AS 109. Now, sometimes what happens is an entity may become an investment entity, or entity may cease to become an investment entity. Now, if entity ceases to become an investment entity, means the entity is no longer an investment entity, then in that case you will take the fair value of the subsidiary on the date of change shall be used at the deemed cost of that date. So whatever is the fair value, that is 100 is the fair value, this will become the deemed cost for the purpose of Ind AS 109. If entity becomes an investment entity, then the entity shall account for investment in subsidiary at FVTPL in accordance with Ind AS 109. Then, if there is a difference between the carrying amount and the fair value, the difference is recognized in P&L. Okay, so with this we conclude the major part of Ind AS 27, separate financial statements. Now, in the entire thing, what we have covered so far, the first part, which is more crucial, that is covering of how to prepare consolidated financial statement, how to account for intercompany transaction, elimination of intercompany transaction, and aspects related to chain holding, right, and acquiring control, disposal of subsidiary. All of these are important. Then sometimes you may get question based on joint arrangement, associates, or joint venture, small questions. Okay. Then lastly, one more thing that we need to keep in mind is control related aspects are sometimes tested in theory, and exemptions related aspects are sometimes tested in theory. So that is what we need to understand here. Okay, are we clear? So with this we conclude consolidated financial statement. Practice as many questions as you can, and I hope you got good amount of conceptual clarity and quick recap and revision of all the concepts, so that you can practice questions well. It actually should act as a refresher to you. I had said that I'll share that chain holding detailed solution. Somehow could not happen into last 2 days. We will have it done in a day or two. That will be provided to you. Any questions? Thanks, Mr. So the next thing that we'll be taking up, let me just I think I put up a schedule slightly behind time, but we'll hope to cover up. So now we'll begin with Ind AS 40 is completed, so Ind AS 2 and 41 is what we'll be starting tomorrow. Okay, Ind AS 2 and Ind AS 41 will start tomorrow. Small standards, but I think this is where you can score that quick 10-15 marks. two questions and you can score just 10 marks just like that. Okay, so in 2 and 41 we'll start off with, then 12, 23, 8, 10, 102, in that order we'll continue in the order that I had said. So far we have covered till consolidation. So I allocated 29 days. Today is day number 29. Yeah, 7:30 is what we'll continue. I think more students are used to. No. So tomorrow I will let you know. If you have session tomorrow, I will let you know. Okay. Chalo. Thanks a lot and have a nice day. Evening actually, not day. Enjoy dinner and practice well. So thanks. Bye bye.